This is Herb Greenberg. It is Wednesday, March 12th. Stocks are mixed. Bonds are down. Yields are up. The big news today is TikTok, which that tells you all you need to know. As always, our group is here to talk investment ideas and what they are working on. With me today is Mr. Russell Young, Jeff Mackey, Bernard Barchet, Robert Morrison, and our resident iconoclast, Mr. Paul Kudrowski. But first, Russell, let's start with you. What are you working on?
Hey, good morning, Herb. So this morning I've been working on solar. And as we've been talking about, solar has been in an upheaval for the past year. First, we had, excess inventories in Europe. And then we had big changes in California where they changed the amount the homeowner would get paid. Essentially, the utilities no longer want your power and they slash rates, which caused solar installations in California to fall by 80%. And over this time period, there's been rumors that Tesla was coming out with a new battery pack. And with the change to NEM 3.0, the battery becomes the central point of the solar installation because...
I got to stop you. NEM 3.0, you're talking, gobbledygook to most people. That's just a change in regulations in California.
Okay, got it. So we've been looking... So in following the changes in California, which slashed payments to homeowners, and there's been rumors that Tesla was coming out with a new solar inverter. And so right now we're starting to see the Powerwall 3 ship, and we're hearing about pricing. And the big news for Enphase is that this is 25 to 30% cheaper than Enphase's solution. And this is a big problem because in this time period, consumers need lower prices, installers need lower prices to get this whole market going again. So when we pull up our chart, when we look at the savings you save about over $10,000 when you put a Tesla Powerwall 3 in your solar install. And this is a big deal. So this can save installers and it can possibly revive solar in California. And Enphase is in a big problem because of this, because at a 23% operating margin in the last 3 quarters, that they'll lose money if they lower prices to compete with this. So we're going to watch the rollout of the Powerwall 3, and I think it's a big problem for Enphase.
And you don't think Enphase comes back with something else other than cutting their margins? There's no other technology they're coming out with that can make them sort of put them on an equal footing?
It's really hard because right now with a microinverter, what Enphase does is they have one electronic device per panel. So the only thing they can really do is try to lower their costs. They're already getting subsidies from the government for these inverters. And what's going to be their magic bullet? They don't have expertise in batteries. They're outsourcing those and bringing those in. And so the only way they can really respond is with price.
So how are you positioned on this?
Well, I've been short Enphase and SolarEdge. When I look at Enphase, it trades at 35 times this year's numbers, and it's the street thinks they're going to earn about 640 in 26. So it looks reasonable off of that number, but I think the company can be losing money by the time we get to 26. So I'm short Enphase.
And this is not a play on Tesla.
No, I think solar is a minor part of the Tesla story.
Okay. I want to point something out. Yeah, I want to point something out. Russell and I collaborated on a more detailed dive into Enphase and into what he says is actually a short position. You can read that at My Pro to Pro, which is right here on thestreet.pro. Russell, one other thing. Yesterday you had mentioned ON. That's On. They make this athletic shoe. What's going on there now, and what are you doing?
Yeah, so I'm staying long. I added a little bit yesterday.
What happened?
Well, what happened is that on the headlines, it looked like a revenue and earnings miss from elevated expectations. And so the bears were jumping up and down, saying, look, the guidance is weak, the numbers miss. But when we boil down the numbers, we can see that it was all driven basically by currency. On is headquartered in Switzerland. Their currency has been very strong, and that's pulling back the results. For an example, when they report their revenues, it was up about 22%. On a constant currency basis, their revenues wouldn't have been up 31%. Asia is booming, up 76%, and yet the company reported like an up 58% number. Analysts were also questioning the guidance for the full year. They said they would grow revenues by 30%, but everyone's focused on the first quarter. In the first quarter, it's not a big quarter for shoe sales, and they're doing some door cleanup in Europe, and so that's holding it back. But most luxury retailers have been through this transition where they're cleaning up their channel, positioning the brand for the future.
So what are you doing? So what's your trade here?
What's the grade? I'm staying long on, and I added a little bit yesterday, and I think this year will be pretty exciting for me.
Is this a trade for you, or is this something you intend to stay with for a longer period of time?
No, I'm looking at this as an investment. This is probably the fastest growing shoe company out there. They want to get into apparel. Apparel is a very small part of the story now. It hasn't been doing well, but that's okay. They have time to work on it. But they're really resonating with consumers.
Okay, great transition for Jeff Mackey, because we're going to shift into retail, which is all things Jeff, and currently even some things shoes, I think. Jeff, what do you have for us?
I've got retail earnings week going on still, Herb, all month of March. We're running a special over here. Dick's Sporting Goods. Now, what happened with On, to the extent it wasn't just currency, they also had, they showed some kind of discretionary purchasing on the side of their vendors, specifically guys like Dick's, but they did mention that they're selling goods at full price. That bodes well for Dick's, who moves a lot of shoes. This company is so much better than they were 5 years ago. They report earnings on Thursday. What I'm hoping for is that we get kind of a vintage Dick's spectacularly cautious guidance, and that sends the stock lower. It's near all-time highs. It's hard to be a bull here. I'm long kind of half a position. But Dick's last summer, they warned on shrink. They became the last major retailer to even mention shrink because the stock got spanked for 20+% in one day. It was at the peak of retail shrink isn't real. That kind of denial phase we went through last summer, tied in with Target, and everybody blaming shrink got killed. That has subsequently reversed. Dick's Sporting Goods, the stock has reversed entirely. It's near all-time highs. If I get to pull back to 150, I'm going to reload the boat. I'm also kind of watching Williams-Sonoma here. It's showing clearly that the stock market is willing to pay up for earnings, even if the outlook isn't as good as you would think, even at 52-week highs. So, I'm feeling a little more comfortable just being long what I am long with Dick's. I'm wishing I had more of it. If I can get a gap lower, Herb, it'll be a little bit of Christmas right here in March, and we're going to load up.
Well, and what's interesting is you talk about these two companies, and we're still talking bricks and mortar, even though what percentage is online for both of these companies?
For who's that? For On?
For both of them. No.
Dick's is not even close.
For Dick's and for Williams-Sonoma.
Oh, Williams-Sonoma has just been an entire transfer. I don't know off the top of my head. I think we're 30-40%, give or take. Dick's is still a moving target, but they've changed their entire business model to a buy and pickup. And so it's really not about necessarily, particularly in sporting goods, which you tend to get at least in the larger size items. You go to pick up a weight set. That buy and pickup is a dream for them. Best Buy has been able to make that work as well. And so you kind of get into that gray area. What do you call this? But what I call it is better retail because they're getting more out of the box. When you take the order online, you have someone pick it up in your store. You can call it whatever you want in terms of DTC or anything else. But the bottom line is that Dick's has figured out how to make their store boxes more profitable. They're extremely cautious on their guidance. They're going to beat. And, it's a buy the dip company, which is the best you're going to do right now. These merchants have been screaming like scalded dogs. It's the good ones are winning, the bad ones are left for dead, and Dick's is a winner.
It's a winner, although, okay. So it's a buy the dip down to 150 is what you're doing. I hate hearing buy the dip. It just gives me the willies because we go back to 2021. But I hear what you're saying.
It gives me the Stevies too. We're at all-time highs, and you can't defer to that, but you have to respect the fact that, man, they have to be better. And there's reason to believe here that we just might get a gap lower. They do it periodically, and I'm hoping for the best.
Of course, you can talk about Dick's, you can talk about Williams-Sonoma. We turn over to Bernard Barchet, and we have the exact opposite when you get to, say, Petco, which you were talking about yesterday, and now there's big news this morning.
Yeah, so Petco shares, they're up 7-8% this morning on really a mostly inline quarter. The comps were a little better. The gross margin was a little worse. Yeah, I would call the results a wash. The big news is that the CEO has left the company, and this is a giant surprise. And this guy was definitely shown the door. He was kicked to the curb. He was not on the call. There was no of that nice leaving to pursue other pursuits language. We wish him well, blah, blah. It was like, he's gone. We're here now. So that was highly unusual. I've only seen that a few times in, 25 years of listening to these kinds of calls. I don't know what to make of it. I mean, a change will probably be good. The lead independent director, Michael Mohan, is stepping in as the interim CEO. He's certainly very qualified for that job. He was the COO of Best Buy during its turnaround years. That's a retailer with over 1,000 stores, a big box. So very translatable experience there. I think the next move for the stock, the next catalyst will be who they manage to get to be CEO at the end of this search. In terms of the results, I think, it's more of the same. The sales are pretty much okay, but the margins are under pressure. And this is a thing the entire industry is going through right now, which leads me to think that this is cyclical and eventually it's going to turn the corner. That said, there's the possibility where I'm wrong. And, Amazon has permanently taken some share of the supplies business, which is the higher margin piece of the business, and left the bricks and mortar guys fighting over the food business, the grocery business, which is the lower margin piece of business. But I think they've got strategies around that. They've got strategies around services, grooming and training. They've got the growing vet business, which is doing great. It's just they're cash constrained right now. So this year for them is going to be about Retail 101, generating cash, and better serving their customer. And it's a retailer. I still, as far as the trade, I'm sticking with it. I see it very bimodal. This is a very asymmetric bet on a turnaround, but I'm willing to bet that they do turn around for a couple of reasons. This is a retailer with scale, $6 billion of sales in a pretty fragmented market. It has good industry tailwinds, secular tailwinds, which is what I talked about yesterday, which is that people want to spend more on their dogs and cats when they can because they love them like their children, and that's not changing. And so they have a couple of things go, and the vet business is a very attractive business, and it's unfortunately it's cash constrained right now. They could be growing it more, but I think it's actually earnings accretive that they grow it slower.
Well, it would be interesting to see. While you're talking, I'm thinking to myself, gee, I wonder if Mary Dillon, who went from Ulta, where she was hailed as a great CEO, to Foot Locker, which is a classic example of a supposedly good CEO being beaten up by the business, if indeed that's the case, decides, well, wait a minute, maybe Petco is the place to go because, in theory, it's a better deal, you would think, than Foot Locker, but maybe not.
Yeah, it's interesting. Mary Dillon would have been perfect here because one of the things that Petco's doing is I think one of the missteps they had is they tried to become kind of the Whole Foods of pets, and they got rid of the whole low end. And then when the market shifted to trade down, they were left without things like Friskies in the store, which they're fixing and putting back now. But they'd gotten, too elite with sort of Whole Foods kind of mix. And so now they're trying to play the game of having, Blue Buffalo and even, higher end $100 bags of dog food for the people who are price insensitive. It's a great customer to have, while also catering to the masses, which is exactly what Ulta did by going mass and prestige and beauty. So it's interesting you bring that up. I don't think that she'll be leaving Foot Locker, but yeah, she would have been a good candidate for this.
We're thinking about, listen, thanks, Berna. Bob Barson, you seem to be coming up with a new idea, I'd say a day these days. What are you looking at right now?
You're talking about pipelines yesterday. So I actually happen to own a pipeline. It's called Plains All America. It's a $17 stock these days. It is an MLP. It issues a K1. So That's a caveat there for some, but it's a very cheap stock. It's trading with a nice 7.5% yield these days. But more importantly, it's locked in, according to management, 3 years of 10 to 15% compound dividend growth. Because last year the company issued a policy whereby it was going to take its free cash flow and continually bump the dividend by 15 to 20 cents a year until the payout ratio or the dividend coverage ratio got to 1.6 times. So you still have an ability, if you could forecast EBITDA over the next 3 years, to assume that the dividend, which is 124 today, 127 today, could be at 160 to 170 by 2026 or 2027. So it's very challenging finding a 9 to 10% yield, even if you have to wait 18 months or 24 months. That is a factor, and that's why it trades at a discount, to the corporate or to the C class versions of the pipeline companies. But it's a great business. It's the leading company in the Permian. Uh, it's mostly oil. It's not a play on natural gas. It's a fuel for electricity, as fuel for transformers, as fuel for data center, AI power driven mumbo jumbo. It's basically an oil play. It's a takeover candidate because it's bite sized for some of the other big companies, and it's reasonably priced at 9 times EBITDA. So it's very hard to find dividend yields that grow at aggressive rates in this space. Most of the MLP are growing their and the common stocks are growing their dividends at 3, 4, 5% a year these days.
Robert, listen, I want to move on to Paul Kudrowski. Everyone's talking AI. Where's your head right now when you think of that?
So I like to think in sort of broader macro terms when it comes to these sorts of things. And so, my analogy historically, and this is probably more than most people want to know, but it's taking things all the way back to prior waves of industrial revolutions, like in the first industrial revolution, and the emergence of some of these new technologies and inventions that cause people to rethink the nature of work and rethink, how much I want to have done by people versus what I want to have done by machines. And I think what people are getting confused about a lot right now are those parallels. We're kind of wrapped up in all of these, isn't it fun to create something that does fake essays, or isn't it fun to create something that creates these charming images? These are all kind of mundane consumer applications. What's really interesting for me underneath all of this is how this current wave of AI is facilitating the emergence of a new kind of capital intensity in the workplace, and specifically in the context of robots. And this is something that you've seen a little bit lately as a number of early stage private companies have been funded by OpenAI and others. But what's particularly interesting is how this is happening much faster than people realize, in particular in Asia, where robots per capita is much higher than it is here in North America, in part because of an aging society and difficulties bringing people in as a part of an immigrant workforce. But we can expect the exact same pressures here. And at the same time, the cost of doing it is collapsing. The cost of bringing in robotic automation is falling because it's predicated on a lot of these AI technologies. So in the past, it was very difficult to train robots to do an awful lot of non-trivial tasks. And so we tried various things. We had things like, iRobot and what have you, but these were very narrow robotic technologies that kind of fell off this, what Gartner calls, into the sort of trough of disillusionment. And people were like, well, this was supposed to change the world and it didn't work very well. The difference is now is we're seeing these general purpose technologies predicated on AI that use what are called multimodal methods. And what that means is you can do more than just one thing. I can observe using video, I can listen using audio, and I can learn from all those incoming signals. And as a result, as a robotic technology, adapt and do things that weren't possible even 5 years ago, and do them at a fraction of the price that we might have done it 2 years ago. And so what that's driving is this incredible wave of interest in robotics, in particular, as I said, in Asia, but it's happening here in North America as well. So that area for me is probably the single most interesting aspect of AI that isn't talked about, and yet is not just emergent, but actually seeing rapid adoption. So the angle that I like to take on this stuff, because it's really difficult. There's an awful lot of different companies who are playing around with using various, LLMs for robotics, that are playing around with using different humanoid robots. We've seen Jeff Bezos and others funding things here. Is to go back to basics and ask yourself, who are the pick and shovel providers to robotics companies? In much the same way, it's useful to think about that whenever any area as a growth equity is really emerging. And so you think about the picks and shovels in the context of robotics are things like actuators, the hydraulic rods, if you will, that allow arms and legs to move. It's the servo motors that allows arms and legs to move, or allows you to reach out and grasp something with some vaguely and frighteningly humanoid hand. These are the aspects of robotics that are currently the most interesting, because they're the things that are finding the most rapid adoption. And at the same time, much like I was talking about last week or earlier this week, they're the things with the supply constraints. So they're able to charge premium prices and find their way into lots of different robotic companies. So it's companies like Omron. ABB is a player here in particular with respect to actuators. KeySense is a really interesting company that's mostly on the vision sensor side of things, again, in the context of these multimodal AIs. So there's 4 or 5 interesting companies here worth looking at. And if people just want to abstract up a level and say, I have absolutely no idea what to look at, if you took NVIDIA out of the BOTS ETF from DirectionX, that's actually a very interesting ETF that gives you a lot of exposure to robotic stocks. It just so happens that I think NVIDIA is like 8%, which is a bit annoying, because yes, it's a player, but it does skew it somewhat.
What is that ETF again?
BOTS, BOTZ.
Which gets zero, which seems to get zero airtime, zero discussion.
So if you just want, even if you want to use it as a happy hunting ground to look at names, which is often a useful way of looking at these things, is I'll find a very domain specific ETF and then look at their holdings. That's one way to go at this. But just to get some quick exposure, I wish it wasn't so exposed to NVIDIA, but a lot of the other holdings inside of that particular ETF are really interesting if you want some quick exposure to the picks and shovel side of robotics.
And it's interesting, if we were having this discussion, it almost sounds like this is a discussion we could have been having 2 years ago, 3 years ago about generative AI. People's eyes would have rolled. They wouldn't know what you're talking about, because it's not being talked about aggressively in the mainstream media. So from that perspective, it seems like this is kind of ahead of the curve. So
and companies are all over this, because just think about rising minimum wages and the need to find to deal with the costs in fast food. It's all of these pressures are coming at it, and approaching this problem and forcing companies to rethink how they allocate capital for exactly these purposes, just as the cost is collapsing and the functionality is improving. It's a kind of perfect storm for robotics.
Okay, let's bring everybody in, and this is an interesting jumping off point. I don't know if anyone has any thoughts on what Paul said, and if not, we can move on to the markets. But in general, first I want to open it up. Anybody on anything before we move on? And the answer
I'm watching Williams-Sonoma, and I can't believe people bet against the high-end consumer to this degree, and the bifurcation between the haves and have-nots. It's up 17, 18%, Herb. I know you got family there. It's a great performance, and I didn't expect it from all-time highs. We haven't seen it from many companies, but this is the have and have-not world. You can't ignore the haves, because holy crap, this is outstanding and just kind of weird. A lot of people must have been short type of behavior for what seems to be light revenues but good margins.
Yeah, how long does it continue? I mean, I know before we got on the show live, Robert, you were talking about your belief that inflation continues, and from a market perspective, you think it's a buy the rumor, sell the news, and the rumor goes on for much longer. Is that what you said?
Yeah, well, I'm not talking about inflation spiking from here as being just the delay in the Fed cutting rates. To me, has a chance to prolong this, because everyone's waiting for the payoff to the first rate cut, and I haven't looked at this historically, so I'll have someone look at what happens after the first rate cut, in a non-recessionary environment, and we'll see. But I would assume a lot of people are holding on to positions and thinking the first time to sell is when the Fed starts cutting rates. The delay could prolong it. Make this a very good year if it takes all year. cyclically, it's a very good year for stocks.
Yeah. Well, right now it is. Anybody else?
I just had a question for Russell. Russell, who makes Enphase's? Who do they buy their batteries from? Is it Panasonic?
I'm not sure on who they buy them from. They haven't really disclosed that, but I'll go and do some digging on that. But most batteries are made by Panasonic and LG and a couple of the big suppliers. And just with Tesla being the largest battery producer and consumer in the world, they have the best leverage in terms of buying batteries.
Yeah, for sure.
Yeah.
After my, go ahead. Go ahead.
Sorry, I just wanted to follow up on the robotics thing because it was, NVIDIA at the TD Cowen Healthcare Conference gave a presentation about the use of LLMs to train surgeries. And they were kind of implying that NVIDIA would be getting into and helping to train robotic surgery. So on your list, I was thinking of, oh my gosh, is Intuitive Surgical? And
there was
other things like that. Really,
there was a terrific piece, and I agree. And there was it's a great example of this trough of disillusionment problem where Intuitive Surgical people, it's like iRobot. People don't even want to name it anymore because it feels like a dirty name. And but it is.
No, the stock is like at all-time highs.
Yeah, exactly. So it has quietly returned. There was a terrific study in the Journal of the American Medical Association earlier this week or last week showing how surgical robotics is making a huge recovery in operating theaters across the U.S. and specifically citing Intuitive as an example.
Yeah. And just thinking back on what made Intuitive so good is it took your average doctor and made them exceptional and made them even better. And you think if you put an AI training mode on top of that makes every doctor even better, and then the number of procedures goes up. So I think it's an interesting trend.
What if it makes them obsolete eventually?
Yeah, exactly.
There's still a surgeon behind every robot. Just remember that.
Yeah, sadly.
One surgeon can operate 6 robots.
Yeah, sure. Okay, listen, this is a great discussion. That is it for today. Thanks for joining us. I'm Herb Greenberg. See you tomorrow.